You're listening to The Voluntary Life, where you can hear ideas for finding freedom in an unfree world. Visit thevoluntarylife.com to connect with the show and hear all past episodes. Here's your host, Jake.
Hi, it's Jake here. Welcome to Voluntary Life. This is part 2 of my review of Harry Browne's book, Fail-Safe Investing. So if you haven't heard part 1, I recommend that you listen to that first. You can find that in last week's episode. And I'm going to pick up where I left off in the previous episode and talk through the remainder of the rules for fail-safe investing that Harry Browne outlines in this book. And I'll give my perspective on each of these remaining rules as I go through and explain them. So rule number 11 is build a bulletproof portfolio for protection. And in this rule, Harry Browne really goes on to explain the whole concept of the permanent portfolio, but he also provides the background rationale for what you're trying to achieve in building a permanent portfolio. And the 3 key concepts that he's going for in this approach to investing are safety, stability, and simplicity. So in terms of safety, the idea of the permanent portfolio is to invest in investments that are tied to specific conditions that might occur in the economy. And the reason for that is that you want your investments to be protected whatever happens to the economy. And I've spoken about this in previous podcasts, so I won't go into detail here. But essentially, the 4 different types of economic condition that Harry Browne outlines are prosperity, inflation, deflation, and a tight money recession. And I'll put a link in my show notes to an interview I did with an expert on the permanent portfolio. The episode was called Financial Preparedness, and we talked through each of these economic conditions: prosperity, inflation, deflation, tight money recession. And we talked through how each of these different economic conditions can impact various classes of investment. So the idea behind the permanent portfolio is that you are ready for any of those conditions because you choose assets to invest in that are going to perform particularly well in any one of those 4 conditions. And that gives you protection insofar as you can be protected from different economic conditions having a huge impact on your investments. And you're much better protected than you would be if you had all of your investment funds in one asset class. So this builds off the idea of diversifying and spreading a risk that I talked about in the rule number 10 in the previous episode. Now, one thing that you might imagine with this is that if you kind of diversify in this way, that your investments are all just going to cancel each other out. You're going to make losses in one investment and gains in another, but in the end, just nothing will happen. And I mean, maybe that's safe, but there's no gain to be had. Actually, the interesting thing is that if you backtest the permanent portfolio over time, that's not what happens. The portfolio gains in value, and it gains very steadily. And there's lots of statistics about that. Depending on which country you look at, the gains tend to be in the range of 8 to 10% per annum on average, looking over the period since the 1970s. Again, I'll put a link to some of the statistics on that so you can see for yourself. Now, the reason for that, the reason it doesn't, that the losses in one part of your portfolio don't just cancel out the gains in another, is something that is referred to as volatility harvesting. So what's going on is that as money is flowing from one investment class to another, for example, out of stocks and into precious metals or out of precious metals and into stocks, when economic conditions change, it tends to be the case that the one asset class that's doing really well significantly outperforms the losses of the asset classes that are doing badly. So in other words, you get this kind of momentum effect, where as long as you have a significant proportion of your portfolio in the asset class that does best in any one of these different economic conditions, then the gains from that class can outweigh all the losses and then some. And so you're able to harvest the volatility of the market and essentially automatically buy things when they're cheap and sell things when they're expensive. So that's a basic sort of idea behind the permanent portfolio. Of course, it works better or not so well in practice, depending on the year and the conditions and the country and so forth. So you can have a look at the past performance to see what you think. But that's the kind of philosophy behind it. And Harry Browne outlines that overall strategy in this book. And a key aspect of the way that he outlines it and the way that he's chosen these different assets to invest in is that he's going for simplicity. The idea of the permanent portfolio is to have a strategy for yourself as an individual investor that isn't super complicated, that doesn't require hours and hours of your time, doesn't create a new full-time job for yourself as an investor, but protects you in different economic conditions and gives you the circumstances to benefit whatever happens. So that's the chapter on building a bulletproof portfolio. And that's what he means by bulletproof, is really protecting yourself in different economic conditions. Rule number 12 is speculate only with money you can afford to lose. So what Harry Browne outlines in this chapter, and what his idea is behind this rule, is that there's nothing wrong with speculating if you want to speculate. If you want to put some of your money into a specific concentrated asset class that you think is going to do really well in future, rather than a diversified portfolio, then there's nothing wrong with that. But his suggestion is that you're just very conscious about what you're doing and that you set aside a separate portfolio called a variable portfolio for your speculations. And that portfolio, you can make up whatever crazy rules you like about when you're going to move in and out of particular assets and how you think you're going to make money. But you don't mix that with the permanent portfolio, which is there to provide you with stable, long-term investment in a sort of fail-safe way. And in this chapter, Harry outlines some of the suggestions about speculating and what works and what doesn't work. And he makes the point that if you want to speculate, the way that big money is made by speculators is you have to really be a contrarian. You're not going to make huge gains if you're doing what everybody else is doing. In other words, for example, if everybody else thinks that a stock is incredibly valuable, the stock price is going to be very high. And if you buy the stock, you're not necessarily going to get a huge amount of gain because you're already buying in at a high level. The gains tend to be made in speculation where you're acting against the crowd and you are, for example, taking a contrarian approach where everyone else thinks that this stock is worthless and you buy it when it's really cheap, and then all of a sudden the majority opinion changes and now the stock's very high in value and you have made money speculating. Of course, the point is there's absolutely no way to guarantee that your speculation of going against the sort of mainstream opinion is going to be right, and you can lose everything in speculation very easily. So there's no way to guarantee that you're going to be right. But the point that Harry's making is, if you think you know better, then by all means go for it. If you think that you have an insight that the majority of the world doesn't, then go for it. But he's making the point that only do that with money that you can afford to lose, because it's wise to have the humility to know that you can very easily be wrong. And by setting up a separate variable portfolio for speculation and doing it very consciously, Harry Browne suggests that you can put a structure in place so that you don't keep funding your losses in speculation from your permanent portfolio. So, for example, by having that very conscious structure, you can avoid the temptation to make up for your losses in your speculation in your variable portfolio by taking funds out of the permanent portfolio. The idea is to put a kind of clear division there and put aside the money that you want to speculate with. But if you lose it, then it's gone and you don't lose money from the permanent portfolio to try again, so to speak. Rule number 13 is keep some assets outside your own country. Now, this is a really interesting aspect of the permanent portfolio and one that really sets it apart from some of the other passive investment strategies that are out there. What Harry Browne was doing with this rule was basically preparing for what some people call black swan events, really unusual, crazy stuff that you can't predict happening that might just turn everything upside down. So imagine that you were in Europe, in 1900, everything seems to be ticking along nicely, and before you know it, 14 years later, there's this huge war, bigger than anybody had ever anticipated, and it destroys a lot of European civilization and wipes out most of the gains of the 19th century and wipes out millions of people along with it. Now, that's the kind of thing that Harry Browne's talking about. Wars, huge economic meltdowns, totalitarian governments coming into power, all these kinds of things that if you're stuck and that kind of thing happens in your own country, it's seriously bad news. On the other hand, you can spend a whole lifetime, worrying about that kind of thing happening and not get on with your life, not enjoy the society that you do live in and take advantage of all of the great things that there are around you, because you're worried that any day now is going to be the catastrophe and meltdown. And Harry Browne had a very pragmatic approach, which was to hold some of your assets outside your own country, just in case, but not to go completely overboard in designing your whole life around this eventuality, and to get on with living as well. And the way that he did this was to suggest that you put 1/4 of your portfolio, the gold portion of your portfolio, abroad. That typically is what most people who use the permanent portfolio strategy do. So the idea here is that you really want to be able to sleep well at night and know that whatever happens, however crazy it might seem now, you'll be okay. And the idea is that if something terrible did happen, like there was another war or there was massive civil unrest or something, and you had to leave the country that you live in, then you would have assets abroad to go to and you wouldn't be sort of destitute. So Harry Browne really did think of everything, I think, in this approach to investing. He really thought through what could possibly happen that could have a terrible financial impact on you, and how could you prepare for it. And that's what this rule is about. In the book, he goes into a lot more detail about how to do this in practical terms and his suggestions and so forth. So you can read all about that if you're interested in the detail. Rule number 14 is take advantage of tax reduction plans. So this is something that many investment strategies try and do, is to really take advantage of the tax-deferred accounts that you can get, retirement accounts and other tax-deferred accounts that allow you to invest and for your investments to accumulate without tax being deducted. And Harry made the basic point in this book that it's a bit of a no-brainer taking advantage of these accounts, because the power of compounding interest is so important that if you can compound your investments without them losing tax, then what you end up with in the end is far, far greater than if you take the tax burden now. Now, it is true that there are potentially downsides to some of these accounts. For example, it is also possible for retirement accounts to get raided by governments that are going bankrupt, and you can potentially have some of your money essentially expropriated or confiscated if it's locked up in a retirement account. So some people are concerned about that kind of thing. But again, I think the point about the permanent portfolio is you're preparing for any eventuality. You're also holding some assets abroad in case there is some crazy government meltdown. And so it's just kind of a no-brainer to take advantage of the opportunity to reduce your taxes legally where you can using these kind of tax-deferred accounts. In the chapter in the book, Harry also suggests that you should be very wary about more sophisticated tax strategies like offshore trusts and so forth. And I mean, he makes the basic point that you really have to know what you're doing if you want to get into that kind of thing. And the whole philosophy behind the permanent portfolio is don't do anything that you don't fully understand and err on the side of safety. And so his suggestion for a simple, good strategy that is going to allow you to enjoy your life and protect you is to take advantage of the tax savings that you can do, but don't get involved in weird stuff that you don't fully understand, like offshore trusts and so forth, because if you don't know what you're doing, there's the opportunity to get ripped off. He also has some other suggestions about tax in the book and some strategic suggestions about which assets to put in tax-deferred accounts. And I won't it's a bit too much detail to go into here, but essentially there are some assets in a permanent portfolio that generate interest, like, for example, the long-term bonds. And that interest will generally be taxed. And so it makes sense to put those kinds of assets in tax-deferred accounts. Whereas there are other assets that you hold for their capital gain value and not for interest, because they don't bear interest, like, for example, gold. So it doesn't make any sense to put those assets in tax-deferred accounts. And he provides some suggestions about how to organize your investment sort of strategically for tax. The permanent portfolio is overall a low-tax investment strategy because there's very little trading and because it's generally based more on capital gain from investments gaining in value than it is for looking for income. So it's a generally low-tax strategy anyway, but he also provides some more detailed suggestions about how to keep your tax as low as you can. Rule number 15 is ask the right questions. I have to say, I think this is a little bit of a vague chapter in the book. I think the general point that Harry was making was that a lot of people have a lot of misconceptions about investing, and therefore they ask investment advisors the wrong questions and they don't think about the right things. And that in general, you have to have a kind of more realistic or more, I guess, grounded understanding of the economy and of investing as a whole in order to benefit from the opportunities that are out there to have a kind of fail-safe investing approach. And he provides a few examples of the wrong types of questions. As I say, I think this chapter is a little bit vague, but in general, I think he was really just wanting to provide a critique of some of the misconceptions people have about investing and the idea that you can seek investment that is completely risk-free, which of course you can't, and this kind of thing. You can read the book to see more of that chapter. Rule number 16 is enjoy yourself with a budget for pleasure. This is a really nice idea, I think, and another aspect of Harry Browne's personality coming through in this book. But what he's doing with this is really talking about not getting trapped in a kind of scarcity mindset when it comes to investing. Many people do not put aside enough money, and that is a huge problem for them. They get into financial difficulties because they spend way too much money, spend beyond their means. And that is a problem that Harry Browne recognized. But he also argued that if you do take a sensible approach to investing, and if you do invest to give yourself some financial freedom, to gain some financial independence, then you want to be able to spend money consciously without being locked into a constant sense of fear or a sense of guilt or a sense of like, oh, I don't know if I can really afford this and so forth. So the basic idea is if you make a budget for yourself so that you know how much you can afford to spend and still stay within your own financial strategy or your own goals, then you can spend that money and enjoy it. And spend it on stuff that you want to spend it on, that is meaningful to you, that gives you a sense of fulfillment, whatever that is, whatever kind of experiences or things are going to give that for you. And that level of spending could be very different. For some people, it would be a very small amount. For some other people, they might want to spend more money. But his point was really make a budget and enjoy it so that you have guilt-free opportunity to just do what you want without worrying over every penny. Once you know what your financial circumstances are and you're more conscious about what you're doing with money, then it doesn't have to rule your life and you don't have to worry about it. You can just get on with life because you know what your strategy is, you know what you can afford and what you can't afford. For those things that you can afford, enjoy it and have a budget for pleasure. So that was rule number 16. The last rule number 17, is whenever you're in doubt, err on the side of safety. And again, this is just kind of Harry Browne's basic approach to investing. Never do stuff that you don't understand. And if it doesn't seem right or if it looks a bit weird to you, don't do it. Work out what's going on first and understand what you're doing. And whenever you have any doubts about something, take the safe approach. That was his approach. And you can understand why he took that approach because, as I said in the very beginning, in the first rule, his concept, and mine too, is that, it's foolish to imagine that you're going to become suddenly rich from investing. Your wealth comes from the value that you create through your work and through your efforts. Investing can amplify that for you, and investing can also keep that safe for you and provide you with, increased wealth. But it's not the basis of everything. And even though some people do get rich from speculation, they're few and far between, and there are many more people who get poor from speculation. And so consequently, if you want a kind of fail-safe approach based on financial safety, then err on the side of safety. So those are Harry Browne's rules, and in the book he goes into a lot more detail. You can read the book to find out all about it. There's a lot more there, but as I said in the previous podcast, I think this is a great book to get started in investing. I really recommend it. It's certainly the best introductory book that I know. There are other things that Harry Browne doesn't tackle, which I think it's useful to find out more information about. In particular, one of the approaches in passive investing that is really important is minimizing your costs and looking at ways to control the costs that you have from investing, the transaction costs and the platform costs. And other costs associated with investment. And this is something that's really much more country specific. So you need to look into the individual funds that are available in your own country and look at books and resources based in your own country for low cost investing. So I'd recommend, there are other things that it's important to read about if you're interested in investing. But if you want a basic overview of how to develop a strategy and what some of the key issues are involved in your strategy for investing, I really recommend this book, even if you don't use the permanent portfolio, because Harry Browne managed to cover all of the key issues that any investment strategy is going to need to tackle in this book. And so even if you choose a different approach, I think it's very beneficial to see just how he built up the approach in this book. So I hope you find that helpful. If you enjoyed this podcast, please leave me a review on iTunes. That would be a big help. If you'd like to support the show, you can donate through the website. And don't forget to check out my book, Becoming an Entrepreneur. You can find that through the website. Just go to thevoluntarylife.com and click on the tab marked books. And if you do read the book and you like the book, I'd really appreciate it if you could leave me a review on Amazon as well. Thank you so much for listening.
Thank you for listening to The Voluntary Life. If you have feedback about the show, please email jake@thevoluntarylife.com. If you enjoyed this program, please share the podcast with your friends or click the donate button on thevoluntarylife.com.